As we are transitioning from early crypto adoption to mainstream adoption, we have some things that I like to highlight that have been developing in the last few months, last few years. Specifically, we finally crossed the 4 trillion market cap, and we've been holding right above 4 trillion market cap. The largest asset right now, as we will also see throughout this presentation, this video today, we're going to realize that NVIDIA alone has a market cap above 4 trillion, just one asset alone. So let's quickly go to other assets. So if you look at NVIDIA alone, sitting at number 10 among all assets, it's at 4.3 trillion market cap. So NVIDIA alone is larger than the entire crypto industry. So this is what we mean by saying we are moving from early adoption to mainstream adoption, but nonetheless, we're still very early in this industry. And we quickly realize why. So another point that I want to highlight also is that besides the most talked about cryptocurrencies, which obviously is Bitcoin and Ethereum, being the number 1 and 2 respectively in terms of market cap, we see that previously Ethereum or Bitcoin used to be at least twice as much in volume, used to trade at least twice the amount in volume than Ethereum. But we see how Ethereum is slowly closing down the gap, and it's almost identical. The trade volume is closing in. It's very near. And why is this so significant? Because if you look at the market caps, you realize that Ethereum is actually 4 times smaller in terms of market cap than Bitcoin. But if it comes to volume, they are very close in volume in trading. So that shows just how much interest there is in both of the first and second largest cryptocurrencies, despite the market cap discrepancy, right? Another thing I want us to highlight also is that if we look at the largest stablecoin, which is Tether, sitting at number 4 right now based on market cap, it has over 110 billion in trading volume. And for the math geniuses, if you do the math, and let's focus on the top 10 cryptocurrencies from Cardano all the way to Bitcoin. Even if you add up all their trading volume, even combined, you still won't get to the 110, including Tether's competitor, USDC. If you add all those numbers together, you still won't be above Tether's daily volume. What does this tell us? This is an indication that Tether is literally, like we said, it's a stablecoin, and stablecoins play a major role and the so-called super apps in this industry. And if you pay attention, Bitcoin, Ethereum, and other cryptocurrencies are paired to US stablecoins, US denominated stablecoins. So this is why you see stablecoins having such high volume, because they are literally paired to these individual cryptocurrencies as well. So if you want to understand the importance of a cryptocurrencies, usually the indicators are also based on the trading volume as well. Besides, of course, the liquidity. So that means how liquid the cryptocurrency, the more liquid the cryptocurrency is, the more trading volume it is. So because stablecoins are required to be backed by US treasuries and they're extremely liquid, that's why you also experience the high volume. So the more liquid an asset is, the more volume it also generates. So those are the things I just wanted to bring to our attention. And focusing on Tether, let's take it a step further and understand what Tether is and why it's leading the path to mainstream adoption. So Tether, USDC stablecoin, and other smaller stablecoins that are about to become mainstream, led by banks, credit card firms, issuers, and other institutions, are literally positioning themselves to issue their own stablecoins. And this is exactly what this article is about, and I would likely just briefly go through it. So stablecoins are entering the mainstream, right? This is what we've been talking about. So we're going from just a small niche to now entering into the mainstream. How do you realize that you're entering mainstream? Is when Fortune 500 companies, Wall Street, banks, and payment giants such as Visa, MasterCard are literally rolling out their own crypto tokens, their own stable coins. That's when you realize that, okay, now we're entering into mainstream adoption, where Fortune 500 companies, Wall Street banks, and payment giants are entering into the space where they're issuing their own stable coins. Circle, which we are paired with, is the parent company of USDC. They also just had an IPO a few months ago. And of course, this triggered a flood of other crypto companies also to go through an IPO, initial public offering. This also signaled, the Senate signaled a shift towards real world utility. So we are entering a phase where we are maturing as an industry, going from a purely speculative industry, highly volatile and very illiquid and young industry, to a more maturing, mainstream focused, Fortune 500 company driven, Wall Street banks, payment processing giant, adding to this industry or wanting to build on this industry, and it's led by stablecoins, right? So, like we said, Visa, MasterCard have also made recent moves in the stablecoin front, right? Another thing I want us to understand here is that, let's go down here. What I want us to understand about stablecoins is that they're literally used to move value around, right? It's hard to move a volatile asset around, but stablecoins literally are pegged one-to-one. So you hold your stablecoin today, a week later, it's still at $1, right? But you can't say the same for cryptocurrencies. It's volatile, right? They move around based on trade during the days, right? So, and this is exactly why stablecoins play a major role, because you can pair them with these cryptocurrencies and you have a steady value that you can trade with and trade purchase items with that is globally acceptable or globally adopted. And also, these same stablecoins are going to be an infrastructure layer, meaning that now you can build products around it. This is why you see Wall Street banks, you see all these institutions and banks, payment giants are literally launching their own stablecoins so that they can use them as products to also cut the fees that, for example, Visa and MasterCard are charging. And we'll see the amount of fees that have been literally paid by these merchants, right, that are accepting Visa and MasterCard, for example. So for corporations, stablecoins are an opportunity to slash millions in transaction fees, right, and turbocharge payment infrastructure with instantaneous settlements. So like we said, stablecoins bring maturity, and they are maturing actually. As we see, like Coinbase, like we say, they announced partnerships with Shopify, which is one of the leading e-commerce platform with over 90 billion transactions it's processing every year. So this is all becoming mainstream. Also, we see how merchants, like we said, are a particular focus for stablecoins, because as payment processing fees for these businesses totaled a record 187 billion just last year alone. That's a lot of revenue that is going to these payment processors, Visa and MasterCard. And there's a lot of money that is that these merchants are actually losing, right? And imagine if they can issue their own stable coins, these merchants, they can save 187 billion in fees. And this is exactly what stablecoins, it's opening doors to all these opportunities. So MasterCard, right, announced support for 4 stablecoins for their multi-token network, Visa, like we just discussed, JP Morgan, and so on and so forth, right? So there's a huge boom in crypto adoption on Wall Street, right? And it keeps growing. And it accomplishes 2 things. On chain, on this, using this new digital technology, it's literally bolstering and bringing awareness and just making the dollar more universally acceptable on chain. And the US dollar, of course, right now is dominating in terms of tokenized fiat currency. The US denominated stablecoin is still dominating by over 99%. And we see how euro is trying to catch up. And we also see how yuan, yen, and other fiat currencies are also trying to put themselves together and start issuing their own local fiat, stable coins on chain as well. But right now, the US denominated stablecoin has a leg up, has a fast move advantage, and we see so many products, US developed, US companies and other institutions that are based in the US, such as Visa, MasterCard, such as JP Morgan, BlackRock, all of them are already building rails on chain, launching their tokenized tokens, building infrastructures on there, and using these infrastructure rails to enhance or even bring more products on chain that are pegged to the US denominated stablecoins. So let's move even farther here. What else are we supposed to see or understand? In terms of the debt crisis in the US, we realize that many nations are hesitant because, like we understand, the US dollar has been downgraded in its credit rating. They hit over 37 trillion in debt, and we see all these geopolitics with the tariffs and weaponizing the dollar. Many companies rather are slowing down in purchasing U.S. Treasuries. So this is where stablecoins really play a major role, because if you look at the largest stablecoin, like we've been discussing, which is Tether, they are already the 18th largest holder of U.S. Treasuries, with over 127 billion in U.S. Treasuries. Imagine this is barely a 10-year-old company, and it's already the 18th largest holder of U.S. Treasuries, and it's just in its early adoption. There is so much more growth that is about to take place. We also understand that, like we've been discussing, there's so much demand for the US stablecoin, and it's also very lucrative, as we're about to see. So we see Japan being the number 1, UK, China, Cayman Islands, so on and so forth on this list. But in terms of Tether, it is the only company that is not even publicly registered. It's just it's the only crypto company that is literally among nations in terms of holders of US Treasuries. So now picture all these banks, institutions with hundreds of billions in cash just sitting around, starting to issue their own stable coins. So you quickly realize that these nations are going to be replaced by crypto companies, banks, financial institutions that are issuing their own stable coins. What this means is that this will bring back demand for the US dollar, and this will also bring demand for US Treasury, US bond markets, obviously. Whenever there's demand for US Treasuries, it has an inverse relationship, meaning that when there's high demand for US Treasuries, the interest rates paid on these US Treasuries go down. So older dated Treasuries that are still on higher interest rates will be in more demand, because now you have a treasury that is in high demand that the world wants, and those that are still older, that have been issued earlier, still having higher interest rates, will be even in more demand. So this is how, using blockchain technology, the US is literally going to tackle the global debt crisis that they're facing, or by literally slowing down the process of inflation. Because now they're no longer depending on nations, but literally institutions are the ones now that are going to be purchasing US treasuries more than actually nations themselves. So let's picture that. Another thing I want us to also understand is that the BlackRock's CIO, Chief Investment Officer, emerges as a leading candidate for the next Fed chair. So Fed chair is a very important post. It's a very important seat to have, because the Feds regulate the interest rates. And as of now, Jerome Powell has been the one holding that position, but his term is going to expire in May 2026. So now having an individual that is actually BlackRock's global head of fixed income and chief investment officer is the leading candidate to become the U.S. Federal Reserve chair of the U.S. Federal Reserve. You see how everything is aligning perfectly for us in this crypto industry. So imagine an investment officer from BlackRock that is so fixated in tokenizing assets, and their CIO is now the next position to be the next US Fed Reserve, right? And will replace Jerome Powell. So we see how this new monetary system that is getting ready to shape up is more and more favorable, and more people are being put in position that are pro-crypto, that are from the traditional financial markets, that really understand economy, understand economics, understand investments, utilities. And all of this is leading our industry, the crypto industry, to become more and more mature as time goes. And utilities, use cases, fundamentals are going to take shape and be more in the forefront, and it will change the current perspective that we see in this industry as a purely speculative industry, extremely volatile, and still no much utility and use cases on it. This is about to take a major U-turn as we see experienced individuals from the traditional financial markets, such as asset manager BlackRock. We see these individuals getting into the office, leading or sitting or taking on high positions in the government, and will be able to issue laws or regulate interest rates in favor of this industry. So another thing that I want us to also understand here is that what we just touched on. So BlackRock, we know what they're seeking. They seek tokenized, to tokenize everything. Tokenized stocks, tokenized real estate, tokenized ETFs, right? Especially after having their very successful products, right? Bitcoin, Ethereum, ETFs, and so on and so forth. This article came out on the 11th of September, right? So it talks about how BlackRock seeks to tokenize ETFs. What I always say is that this is not news. It sounds like, oh, it's news, and BlackRock just 3 days ago, decided that they want to start tokenizing ETFs. I want to bring something to our attention, community. So yes, BlackRock Inc. is exploring how to make exchange-traded funds available as tokens on the blockchain, according to people familiar with this matter. The firm is working on tokenizing funds tied to real-world assets, such as stocks, subject to regulatory considerations. So tokenization could mean trading beyond Wall Street's set hours, right? Not from Monday to Friday, 9 to 5. but 24/7 on chain, right? Making US products easier to access abroad and creating potential new users as collateral in crypto networks. So we realized that all these products that are being pushed based on global adoption of the US dollar, and also for use as collateral. Let's identify that. Let's look at that even closer. And again, this article is 3 days old, and it talks as if BlackRock just 3 days ago decided to do this. But let's look at something else. I want to bring this to our attention. This article is almost exactly 2 years old, right? So October 11th, we're in September 14th today. So almost 2 years old, this article is. And it talks about how BlackRock and Barclays joined JP Morgan's tokenized collateral network, right? And again, October 11th, this is 2023, so almost 2 years ago. So it talks about how JP Morgan's Onyx division unveils tokenized collateral network with BlackRock and Barclays going live, right, on digital asset platform. So the first transaction involved BlackRock tokenized shares in a BlackRock money market fund. Money market fund are ETFs, as simple as that. Keep in mind, this article is just 1 month shy of 2 years. And what did we say? Why are they doing this? They're pledging this because they want to use it as what? As collateral, right? For the derivatives market. The derivatives market is a $1 quadrillion market, and collateral plays a major role. And why are they doing this? It's because one of the challenges with collateral is the transfer of ownership of assets. It takes time to settle in its current stage. But in contrast, using blockchain and tokenization, it's possible to settle instantly. So having collateral in the real world right now, the challenge is that you can't transfer ownership as fast. But using blockchain and tokenizing everything, like BlackRock is pushing and campaigning for, it will make things so much easier, and the settlement can be instantly. Another thing I want us to highlight and close out with is that BlackRock and JP Morgan have been working together on this for how long? More than a year. More than a year. And this article was back in 2023. So that means that adding 1 year to the already 2 years, so they've been working already for over 3 years on this. Specifically, BlackRock and JP Morgan have been working together on this for more than a year. Both have their tokenized collateral network from JP Morgan is on Ethereum. BlackRock's tokenized treasury is on Ethereum. So naturally, whenever BlackRock decides to tokenize these ETFs, it's only safe to say that they're going to also issue them on Ethereum as well. It's safe to say, because they already have the infrastructure. They've been working for over 3 years together on this. The aim is for collateral. JP Morgan already has their tokenized collateral network on Ethereum using BlackRock's ETFs, tokenized ETFs, getting ready to use that. And BlackRock already has Biddle Fund, which is the largest tokenized treasury, also on Ethereum, as we're about to see again. It's already on Ethereum, so it's only safe to say that BlackRock seeking tokenized ETFs, they're going to launch it as well on Ethereum as well. Of course, they might also launch them on other blockchains as well. However, I believe the very first fund is going to be launched on Ethereum. And now I want us to look at this chart once more. So the first thing I want us to highlight is these are assets ranked by market cap. These are global assets based on market cap. So what I highlighted in blue is to show us that 1,000 trillion means 1 quadrillion. So the world's total asset combined in value is 1 quadrillion US dollars, 1 quadrillion. And as we see, the largest asset is real estate, right? With over 665 trillion in market cap. And then oil with over 112, and then the Chinese yuan, right, at 46 trillion, and then gold, and so on and so forth. So you identify that the US dollar, being the global reserve currency, is the Chinese yuan is more than double the size of US dollar in terms of market cap. And this is something that the US is trying to combat by being the first mover on chain and ensuring that they tokenize all these assets that we see on this list: real estate, commodities, companies, tokenizing stocks, so that they can compete with the Chinese yuan. So in the traditional world, the Chinese yuan is twice as large in terms of market cap, right? And for a global reserve currency, this is not supposed to be. US is supposed to be the dominant fiat currency. But they've been losing grip because while China it is the global factory and literally has trade surplus every year, the US is in a trade deficit and has the largest debt amount in the world with 37 trillion. So, but the reason why I'm showing this asset market cap is, let me scroll down. Like I said, you see these different fiat currencies. You see gold, you see real estate, you see commodity, you see stocks, Nvidia, Microsoft, Apple, so on and so forth, Bitcoin. You see even more, the Swiss franc, you see Tesla, you see nations, of course, and then you see Ethereum down here. What I want us to understand is, if we go back to the 90s, the early 90s, two things I want to highlight. The first thing is, that's when, in the early 90s, that's when the internet was globally accessible to everyone. 1993 to be specific. So back then, if we could go back right now, there is no chance for us to invest in the internet, because the internet, even to this day, it's just the technology. It's just the technology. It's not an asset. The internet is not an asset you can invest in. It's a technology. But now we're at a time where, for the first time in financial history, you have a technology known as Ethereum that is an asset at the same time that has a market cap here, that has a price. And this has never happened before. Like we talked about earlier, we saw Visa right above Ethereum and MasterCard launching their stablecoins and have their stablecoin platforms also on Ethereum. We see how Singapore is very favorable towards Ethereum, and they're offering Ethereum staking products, right? We see JP Morgan, they have their tokenized network, a collateral network, also on Ethereum, right? We see Tesla as a stock that is literally also in talks of being tokenized. All these stocks are getting ready to be tokenized and traded on Ethereum as well. And then we see nations such as Switzerland that are already heavily into Ethereum as well, using Ethereum as a blockchain, as a technology, but also offering staking, being the validators for Ethereum staking as well. And then we see even more nations. We see, again, some more stocks. We see some more commodities, and even ETFs such as Bitcoin ETFs, like we just discussed, that BlackRock are getting ready to tokenize. They want to tokenize ETFs, right? And then launch them on Ethereum to be used by JP Morgan on their tokenized collateral network as collateral for the derivatives market. And then if we go further up, we further see Apple, Microsoft, Nvidia. These are all stocks that are getting ready to be also tokenized and launched on Ethereum predominantly to be traded, of course, on other blockchains as well. However, right now, predominantly, Ethereum is the platform of choice, as we're about to see even more. So real estate getting ready to be also tokenized, commodities such as oil, fiat currencies right now on chain, the US dollar is the dominant. We saw the euro also chose Ethereum to launch their euro tokenized, a stable euro stablecoin. And we see that all these assets, majority of them, whether it's a stock, whether it's a commodity, whether it's gold, they're getting ready to be tokenized and launched on Ethereum, which sits at number 43 right now. And Ethereum is not just a technology like the internet was in the early 90s. It's an asset you can also invest in. And all these assets ahead of Ethereum, most of them are going to be tokenized and then traded, launched on Ethereum. And this is what I want to bring to our attention, community. And to really highlight this, I want us to look at how young this market still is. For example, if you look at stablecoins, only sitting at 280 billion. Now, keep in mind, the foreign exchange is the most liquid asset, sitting at 2.4 quadrillion. So you see that this is still 10,000x away from the real value of Forex. And majority of it is on Ethereum, as you can see. Same with treasuries. Treasuries are very liquid asset, sitting only at 7 billion right now. And also, if you look at it closely, 75% of tokenized treasuries are already on Ethereum. And if you look at the overall market, real world assets, like we just saw, assets are 1 quadrillion, 1 quadrillion assets, like we just saw earlier. And right now we're only at 29. These are real world assets. And tokenizing of assets are the futures. What about to start taking place, including stablecoins, ETFs, stocks, commodities, real estate, you name it. All of that are getting ready to be tokenized, and then predominantly it's going to be on chain. And you see here private credit. Private credit is a huge deal. This is exactly what you mean by these financial institutions like JP Morgan. They want to be able to issue private credit, but they want to use all these tokenized assets, including this tokenization of ETFs and stocks. Like they're partnering with JP Morgan. With BlackRock. They've been working on this for over 3 years to issue, to have an infrastructure of collateral, tokenized collateral network, also on Ethereum, to use all these tokenized assets, including ETFs and stocks, as collateral for the derivatives market. And this is where everything is heading towards. So if you have an asset back here, if you have an asset that is actually a technology like Ethereum is, unlike the internet, where everything is being built on top of the internet, all these companies are built on top of the internet. However, the internet itself is not an asset until blockchain technology was developed. So blockchain is a technology, and there's different ones, right? Like Bitcoin is a blockchain, Ethereum is a blockchain, there's Cardano, there's Solana, Binance, you name it. However, like we looked at the beginning back here, if you want to see activities that are happening predominantly, the most activities are happening on Ethereum and Bitcoin. They have the most volume right now in terms of cryptocurrencies. But if you look at stablecoins, like we said earlier, stablecoins have the largest volume. So even though USDC is here based on market cap, it's sitting at number 7. But if it's based on volume, it's actually the 4th largest, only behind Bitcoin, Ethereum, and Tether itself. So what are we saying here? What we're talking about here is that the largest smart contract blockchain by far right now, which is number 1, is Ethereum. This is where the most real-world assets, stable coins, tokenizations are getting ready to be taking place. This is where infrastructures are built by payment giants such as Visa and MasterCard. This is the rails where JP Morgan and BlackRock have been working for over 3 years building rails using tokenized assets as collateral for the derivatives market, using JP Morgan's tokenized collateral network, all built on Ethereum. So knowing all of that now we have a technology known as Ethereum, that is also an asset that you can invest in, that you can stake and even earn yield on, and that all these tokenization of assets. I just want to emphasize this and let us know what we are about to experience right in the future. And back to stablecoins. Why are individuals and companies so eager, banks, to issue their own stablecoins? It's not because they're passionate about the crypto industry, but because the profits. Like Tether just set a new profit record with almost 5 billion, 4.9 billion just in second quarter alone, 2025, second quarter. Almost 5 billion within 3 months. So stablecoins are extremely profitable. And how are they making money? With their treasuries, right? US treasuries, by buying US treasuries, and they earn 4% on that. So this is how they're generating revenue passively. This is how profitable it is if you're a stablecoin issuer. So for these banks and institutions, it's very appealing to issue your own stablecoin, knowing that you can make such amount, right, just in quarter. And Tether, being a small, like, relatively young crypto company, is actually making the same amount of profits like the largest asset manager in the world. Don't take my word for it. Let's look at the numbers. So BlackRock, as we know, is the world's largest asset manager, and they've been firing on all cylinders, like the number says, right? So you see here they have over 11.6 trillion assets under management during the 2024. So what I want us to also look at is that BlackRock was founded in 1988. So that's over 37 years ago, right? That's 37 years ago. Tether is only, but nonetheless, this is how much BlackRock's revenue was, right, for the same quarter. So BlackRock's revenue was 5.4 billion. 5.4 billion. And we just saw Tether. Tether revenue is 4.9. 4.9. So relatively close. So almost identical. So here is a 10-year-old company, 11-year-old, from 2014 to 2020. So 11-year-old company, crypto project, with barely 100 employees, is generating almost 5 billion in a quarter. And that's the same amount, roughly the same amount, like the largest asset manager in the world is making in a quarter. Now, the difference is these are asset managers. This is assets under management that they have. This is not BlackRock's asset. In comparison, these are Tether's assets. Tether owns these assets. This is their asset. It doesn't belong to their clients, their customers. That's the major difference. And this makes all of this even more appealing, because now you're not just a regular asset manager, but you're managing literally your own assets, not other people's assets. And that's a major difference. So these are the things I really wanted us to understand and highlight, that yes, stablecoins are becoming mainstream. They're the ones that are literally causing, you see how all these different institutions, let's come back here, all these different institutions, right? Banks, credit card firms, and Wall Street companies, Fortune 500 companies, payment giants, they all want to issue their own stablecoins. It's because it's extremely lucrative, for one, and also with the clear regulations, stablecoin regulations, it also brings demand for the US dollar, it brings demand for the US treasuries. And like we saw here as well, we see that, where is it? We see that all of this is going to benefit the US in the long term, because now nations are not, US doesn't have to rely on nations anymore, but they can rely on their local banks, asset managers, Fortune 500 companies, and to purchase all these treasuries, US treasuries, because they're legally required to back their stable coins with US treasuries. And also on-chain, predominantly the US dollar is dominating on-chain activities in terms of stablecoin by over 90%, right? So not just having the fast move advantage, not just globalizing the US digital dollar with stablecoins, but also bringing demand to the bond market. So US is positioning itself highly in this digital race to become literally the leader in all of this, because the financial hub, the financial center of the world where all the liquidity comes to and investments are taking place is in the US. And all of these, they're planning to tokenize everything and bring it on chain. On chain, these assets, tokenized assets, will need to be paired with a stablecoin. And the majority of stablecoins are US denominated. And these stablecoin issuers are not limited to crypto companies. They're also Fortune 500 companies, like we said, banks, institutions, and so on and so forth. So we realize that we are very early in the stage, like we see here. We are sitting at a 4 trillion market cap. So this is a very small market cap, small industry. And we are moving, like we said at the beginning of this session, we are shifting from early adoption to mainstream adoption. And this gap is getting ready to be closed very, very fast. And this is the cycle to do so. So it's important for us to bet on the right horses, bet on fundamentals, because in the long run, as this market matures, its utilities, fundamentals, use cases, that is going to matter. All the hypes, speculation, pump and dumps are going to dry out. I'm not saying that they're going to be eliminated fully. However, it's not going to be relevant as much anymore, because once the markets become mature, liquid, it's going to be fundamentals, utility, tokenomics that are going to dictate where individuals want to place their funds in, their money in. And it's those type of strong, fundamentally strong cryptocurrencies ecosystem that are going to make the most out of this cycle. So that's it for today, community. I hope this session was informative to you. And till we meet again, community, I want to wish you a wonderful rest of your weekend. And for the Queens tomorrow, I want to wish you a wonderful session on Sunday. Till we meet again,